Hi, I'm Jeff Colton. How should responsible management principles impact on your organisation's accounting? Today we'll focus on the preparation of the financial statements, the role of pro forma or non-GAAP performance measures, and expanded disclosures that organisations are making. Responsible management considerations impact on many parts of an organisation's accounting function. I'm going to focus here on financial accounting. We typically think of two separate areas of accounting. One of these, financial accounting, is concerned with the production of the financial statements, such as the income statement, the balance sheet, and the cash flow statement. This provides information for those external to or outside the organisation. The aim of financial accounting is to record, measure, and summarise the economic impact of an organisation's business transactions. Second, we have management accounting, which is concerned with the production of information for internal use. This includes information about budgeting, CapEx decisions, and product and service costing. Management accounting information can be used for communication, for control, for planning, and for performance measurement and reward. A key purpose of accounting has to do with the assurance of integrity in the generation, distribution, and use of resources. People who control resources, ranging from agricultural products to currencies, have always had an interest in monitoring and therefore in measuring the number and quality of items of value. So where does responsible management come in? Organisations producing financial statements are required to follow the accounting rules. Responsible management dictates that the rules should be followed. Accounting, and by extension financial management, depends on information having integrity. That is, accounts need to present an accurate and reliable picture of the world as it is. If they don't, decisions relying on the accounts will be suboptimal, increasing risk, voiding contracts, all of which will undermine the conditions for the operation of a genuinely free market and cause otherwise avoidable harms. This is why all accounting rests on a general requirement that accounts be true and fair. It should be noted that the concept of accounts being true and fair holds a primacy such that even established accounting standards must be overridden if their application would, inadvertently, lead to accounts that are not true and fair. The existence of a true and fair override applies in Australia and in all other jurisdictions covered by the International Accounting Standards Board. Now, it might all seem to be a little abstract. However, the ethical foundations of accounting and financial management are of immense importance to responsible managers. Indeed, the very idea of being responsible assumes that decisions made by managers are well informed. That is, a responsible manager is one who is diligent in ensuring that they act on the best available information, not only to achieve intended outcomes, but also to guard against the unintended misfortunes that can befall the uninformed and ill-informed. Responsible managers have a positive obligation to act on good information. To not know is to invite the charge of reckless indifference. Given this, responsible managers have a direct personal interest, in addition to any corresponding duties, in understanding, promoting, and securing the ethical foundations of accounting and financial management. Despite this, there are countless examples of managers seeking to misrepresent the true state of affairs. At times this has been done to secure an otherwise undeserved advantage, such as when misrepresenting a financial state of affairs in order to secure debt or equity financing, to cover up wrongdoing of failure, for example not having met expectations created in the market, or to achieve a combination of both of these things. We have ongoing examples of bad accounting over the years. Enron's our textbook example, matched by HIH Insurance here in Australia. More recently, Dick Smith went into liquidation due to a combination of bad decisions and questionable, at best, accounting practices. Each of these examples invites the question, what would lead someone to be so evidently dishonest? Some possible explanations include the thrill of beating the system, a general indifference to or disregard for strangers, that is, people not of our tribe, or just following orders, or a combination of all of the above. While such factors are often involved, one of the most powerful drivers of conduct lies with incentives. In most, if not all of the cases mentioned above, the system of incentives operated in a way that rewarded outcomes, such as meeting an earnings target, while being largely indifferent to the means employed. For managers, the incentives to manipulate financial reporting outcomes typically fall into two categories. First, market-based incentives, and second, contractual incentives. Market-based incentives include the desire to maintain stock price, meet analyst forecasts, and so on, while contractual incentives come from contracts that allocate wealth based on accounting outcomes. These include the pay and bonus conditions for the CEO and senior executives, and restrictive covenants in loan agreements. Responsibility for the design of the system, policies, and structures of an organisation lies with management. But what if it is the rules themselves that are part of the problem? Managers often complain that the accounting rules don't allow them to do a good job of accurately conveying the underlying economic performance of their businesses. This is one explanation for the increase in disclosure of performance measures that don't follow the accounting rules. These measures are known as pro forma or non-GAAP measures and could be things like underlying profit before tax, adjusted EBITDA, or core earnings. There are two competing arguments about pro forma earnings numbers. On the one hand, they could be used by managers to mislead others about the true performance of the business. On the other, the pro forma numbers could in fact provide a better measure of performance, which suggests that it would lead to better decision making by anyone using these measures. When presenting these non-GAAP or pro forma performance measures, responsible management dictates that the measures should be transparent, consistent, and ideally informative. Transparent means that anyone can easily reconcile the way in which the GAAP measures has been adjusted to give rise to the non-GAAP or pro forma measure. Consistent means that the same types of adjustments should be performed each year rather than cherry-picking the adjustments on an ad hoc basis. Happily, research does suggest that, on average, the pro forma numbers are more closely associated with stock returns than the corresponding GAAP measure. This sort of test is one way that we can try and measure the extent to which a performance measure is informative. These days, investors care a lot about environmental, social, and governance factors. These things are not particularly well reflected in financial statements, but they could be, they could be reflected in other statements. ESG is particularly front of mind for large listed businesses at the moment. This comes from shareholder pressure. Both activist large shareholders like BlackRock, as well as retail shareholders, your mums and dads. In some cases, regulators require it. The broadening of accounting beyond narrow matters of finance has therefore increased the range of stakeholders whose interests are affected by accounting. For example, accounting for greenhouse gas emissions allows informed judgments to be made not only by individuals, but importantly, by whole societies interested in curbing what they see as the risk posed by climate change. We can find similar extensions of accounting to cover aspects of the UN Sustainable Development Goals in areas as diverse as poverty, small-scale fisheries, biodiversity, ethical sourcing of materials, and gender equity. Sustainable performance reports, like traditional financial reports, can help reduce uncertainty and even improve forecasting of things like cash flows. However, it's critical that you don't just report on what you think others want to hear. You need to make sure that your claims are well-founded, that your organisation's values do reflect its ESG or CSR priorities. In running your business, you'll also need to think about how to let stakeholders know that your ESG-related information is credible. In the same way that we have auditing for financial statements, think about ways of working with those who can provide assurance or integrity for your ESG disclosures. If you're an accountant, this is a big opportunity. How often does a completely new set of information sources come along that requires measurement and assurance? I think we're going to increasingly see responsible management in leadership and MBA courses because, unfortunately, as much as we'd like to think that this is something that would come naturally to people, there's been sufficient evidence over decades now that this isn't necessarily something that is front of mind. And by getting the MBA candidates to specifically focus on this, we think that we can get both a greater individual and indeed a collective buy into the principles that we want to espouse. Certainly from my experience this year with the full-time MBA cohort, there did seem to be a really good cohort effect there, that this was something that they would all encourage each other to be part of and to be aware of. And given that the networking effects of an MBA are a really important part of what we're finding out, what our students are getting out of the program, if this is something that we can bed early on, then I think there's a much greater chance of that being a long-lasting effect that we can have on the MBA candidates and indeed on their role as managers and leaders of the future. In summary, responsible management in the accounting function involves ensuring that the financial reporting process is capable of complying with the rules, providing accurate and informative disclosures both of financial information and increasingly for a broadening suite of non-financial measures.